Hello students, welcome to EPG Pathshala. I, Dr. Pragya Dheer from Department of Commerce and Management, University of Kota. Today, we are going to talk on module Human Resource Accounting from paper Human Resource Management. The aim of the Human Resource Accounting is to depict the potential of employees in monetary terms. This concept can be examined in two directions, that is, cost of human resource, that is, the expenditure incurred for recruiting, staffing, and training the quality of the employees, and value of human resources, that is, the yield which the above investment can yield in the future. Introduction. To ensure growth and development of an organization, the efficiency of people must be augmented in the right perspective. Without human resource, the other resources cannot be operationally effective. The original health of the organization is indicated by the human behavior variable like group loyalty, skill, motivation, and capacity for effective interaction, communication, and decision making. Men, materials, machines, money, and methods are the resources required for an organization. These resources are broadly classified into two categories, that is, animate and inanimate, that is, human and physical resources. Men, otherwise known as human resource, are considered to be animated resources. Others, namely materials, machines, money, and methods, are considered to be inanimate or physical resources. For a long period, importance of human resource was not taken care of seriously by the top management of the organization. Therefore, at this junction, it becomes imperative to pay attention on proper development of such an important resource of an organization. Meaning, the traditional concept suggested that expenditure on human resource is treated as a charge against revenue as it does not create any physical asset. At present, there is a change in this concept, and the expense incurred on any asset as human resource should be treated as capital expenditure as it yields benefits which can be derived for a long period of time and could be measured in monetary terms. Human resource accounting is the measurement of the cost and value of people to the organization. It involves measuring cost incurring by the organization to recruit, select, hire, train, and develop employees and judge their economic value to the organization. Human resource accounting is the process of identifying and reporting investments made in the human resource of an organization that are presently unaccounted for in the conventional accounting practices. It is an extension of standard accounting principles. Measuring the values of human resource can assist organization in accurately documenting their assets. Human resource are considered as important assets and are different from the physical assets. Physical assets do not have feeling, emotions, whereas human assets are subject to various types of feelings and emotions. In the same way, unlike physical assets, human assets never gets depreciated. Therefore, the valuation of human resource along with other assets are also required in order to find out the total cost of an organization. In 1960, Rensis Likert, along with other social researchers, made an attempt to define the concept of human resource accounting. What are the definitions which defines HR accounting? According to the American Association of Accountants, human resource accounting is the process of identifying and measuring data about human resource and communicating this information to interested parties. In simple terms, it is an extension of accounting principles of matching cost and revenues and of organizing data to communicate relevant information in financial terms. Flemmontis defines human resource accounting as accounting for people as an organizational resources. It involves measuring the cost incurred by the organization to recruit, select, hire, train, and develop human assets. It also involves measuring the economic value of people to the organization. According to the Stephen Knopf, human resource accounting is the measurement of quantification of human organizational inputs such as recruiting, training, experience, and commitment. Mr. Woodruff, Junior Vice President, R.G. Betty Corporation, defines it as follows. Human resource accounting is an attempt to identify and report investment made in human resource of an organization that are presently not accounted in conventional accounting practices. Basically, it is an information system that tells the management what changes over time are occurring to human resource of the business. M.N. Baker defines human resource accounting. Human resource accounting is a term applied by the accountancy professions to quantify the cost and value of employees to these employing organizations. According to Stephen Knopf, the measurement of quantification of human organization inputs such as recruiting, training, experience, and commitment. Thus, human resource accounting may be defined as a process of accounting which identifies and measures human resource for the use of management to cope up with the change in this quantum and quality so that equilibrium could be achieved in between the required resources and the provided human resources. In short, human resource accounting is the art of valuing, recording, and presenting systematically the worth of human resource in the books of accounts of an organization. This definitions brings out the following important characteristics, features of human resource accounting. First, valuation of human resources. Second, recording the valuation in books of accounts. Third, disclosure of the information in the financial statement of the business. Objectives of human resource accounting. The aim of the human resource accounting is to depict the potential of HR in monetary terms while casting the organization's financial statements. The concept can be examined from two dimensions, the investment in HR and the value of HR. The main objectives of human resource accounting systems are as follows. First, to furnish cost value information for making proper and effective management decisions about acquiring, allocating, developing, and maintaining human resources in order to achieve cost-effective organizational objectives. Second, to monitor effectively the use of human resource by the management. Third, to have an analysis of the human asset, that is, whether such assets are conserved, depleted, or appreciated. Fourth, to aid in development of management principles and proper decision making for the future by classifying financial consequences of various practices. Fifth, in all, it facilitates valuation of human resources, recording the valuation in the books of accounts and disclosure of the information in the financial statement. Further, it is to help the organization in decision making in the following areas, that is, direct recruitment versus promotion, transfers versus retention, retention versus retrenchment, impact on budgetary control of human relation and organization behavior, and decision on reallocation of plants, closing down existing units and developing overseas subsidiary, etc. Need of human resource accounting. The need for human asset valuation arouses as a result of growing concern for human relation management in the industry. Behavioralist scientists concerned with management of organization pointed out the following reasons for human resource accounting. First, Under conventional accounting, no information is made available about the human resources employed in an organization, and without people, the financial and physical resources cannot be operationally effective. Second, the expenses related to human organization are charged to the current revenue instead of being treated as investments to be amortized over a period of time, with the result that magnitudes of net income is significantly distorted. This makes the assessment of firm and inter-firm comparison difficult. Third, the productivity and profitability of a firm largely depends on the contribution of human assets. Two firms having identical physical assets and operating in the same market may have different returns due to differences in human assets. If the value of human asset is ignored, the total valuation of the firm becomes difficult. Fourth, if the value of human resource is not duly reported in profit and loss account and balance sheet, the important act of management on human asset cannot be perceived. Fifth, expenses on recruitment, training, etc. are treated as expenses and written off against revenue under conventional accounting. All expenses on human resources are to be treated as investments since the benefits over a period of time. Now we are discussing about the importance of human resource accounting. First, it helps the management in the employment, locating and utilizing of human resource. Second, it helps in deciding the transfers, promotion, training and retrenchment of human resources. Third, it produces a basis for planning of physical assets, vice versa for human resources. Fourth, it assists in evaluating the expenditure. Fifth, it helps to identify the causes of human labor turnover at various levels and taking preventive measures to contain it. Sixth, it helps in locating the real cause for low return on investment. Seventh, it helps in understanding and assessing the inner strength of an organization. Eighth, it provides valuable information for persons interested in making long-term investments in firm. And last, it helps employees in improving their performance and bargaining power. Benefits of human resource accounting. The main benefits of human resource accounting are: first, human resource accounting helps the company ascertain how much investment it has made on its employees and how much return it can expect from this investment. Second, the ratio of human capital to non-human capital computed as per the human resource accounting concepts indicate the degree of labor intensity of an organization. Third, human resource accounting provides a basis for planning of physical assets, vice versa, human resources. Fourth, human resource accounting provides valuable information to investors interested in making long-term investments in service sector companies. Fifth, this system of human resource accounting discloses the value of human resources which help in proper interpretation of return on capital employed. Sixth, managerial decision making can be improved with the help of the human resource accounting. Seventh, the implementation of human resource accounting clearly identifies human resource as valuable asset which helps in preventing misuse of human resources by the supervisors or superiors as well as by the management. Eighth, it helps in efficient utilization of human resources and understanding the evil effects of labor unrest on the quality of human resources. Ninth, this system can increase productivity because the human talent, devotion, and skills are considered valuable assets which can boost the morale of the employees, and it can assist the management for implementing best methods of wages and salary administration. There are certain limitations of human resource accounting. First, no standard procedure is being opted so far. Second, Some standards of conventional accounting is not acceptable. Third, it is based on assumptions, and as we all know that assumptions are normally uncertain or unrealistic. Fourth, it is believed that human resource cannot be depreciated, which is not real. Next, lifespan of human resource cannot be estimated, as we all know that humans have a time estimation. Next, period of existence of human resource is uncertain. No empirical evidence that HR is a tool. Next, no particular form and manner is there for its financial statements. There is a problem for management to treat them as an asset. There is a constant fear of opposition from trade union because employees are treated as assets or they are used for accounting, but the laborers are not. There is no tax law which recognizes human being as an asset, and no universally acceptable method are present for the human resource valuation. Role of human resource accounting managers. As organization has adjusted to environmental challenges, the roles played by HR professionals has changed. Based on the American Society for Training and Development study results, Pat Melkin states that contemporary professional performs 9 distinct roles. That is, first is the HR strategic advisor, which consults strategic decision makers on HRD issues that directly affects the articulation of organization strategies and performance goals. Output includes HR strategic plans and strategic planning, education and training programs. Second is the HR system designers and developers, which assist HR manager in the design and development of HR system that affects organization performance. Outputs include HR program designs, interventions, strategies, and implementation of HR programs. The third is organization change agents, which advises management in the design and implementation of change strategies used in transforming organizations. The output includes more efficient work teams, quality management, intervention strategies, implementation, and change reports. Fourth, the organization design consultant, who advises management on the work system design and the efficient use of human resources. Output includes intervention strategies, alternative work designs, and implementations. Fifth, the learning program specialist or instructional designer, who identifies needs of the learners, develops and design appropriate learning programs and prepares material or other learning aids. Output include a program objective, lesson plan, and intervention strategies. Sixth is the instructor or facilitator, who presents materials and lead as facilitates structured learning experiences. Output includes the selection of appropriate instructional method and techniques and the actual HRD program itself. The seventh is the individual development and career counselor, who assists individual employees in assessing their competencies and goals in order to develop a realistic career plan. Output includes individual assessment, sessions, workshop facilitation, and career guidance. Eighth is the performance consultant or coach, who advise line management on appropriate intervention design to improve individual or group performance. Outputs include intervention strategies, coaching designs, and implementations. And last, 9 is the researcher assess HR practices and programs using appropriate statistical procedures to determine their overall effectiveness and communicate the result to the organization. Output includes research design, research finding, and recommendations and reports. Approaches to HR accounting. The traditional accounting practices simply ignores the value of human factor in the organization and prefer to treat it as and expense and expendable factors, since it is divided into two based approaches, that is cost based approach and value based approach. Cost based approaches. This approach is also called human resource accounting approach. It operates like a traditional financial accounting system. It assumes that the value of a human asset can be estimated properly through the historical investments or cost incurred. There are four important cost concepts available to the measure of the cost of human assets. First is historical cost, second replacement cost, third opportunity cost, and fourth is standard cost. Now we are discussing about the approaches of human resource accounting. First of all, historical cost approach. This approach was developed by William C. File and assisted by R. Lee Brunel and Eric C. Felmontis and R. G. Berry Corporation, a leisure footwear manufacturer based in Columbus, Ohio, USA in 1967. In this approach, actual costs incurred on recruiting, hiring, training, and development, the human resource of the organization are capitalized and amortized over the expected useful life of the human resource. Thus, a proper recording of expenditure made on hiring, selecting, training, and developing the employees is maintained, and a proportion of it is written off to the income of the next few years during which human resource will provide services. If the human assets are liquidated prematurely, the whole of the amount not written off is charged to the income of the year in which such liquidation takes place. If the useful life is recognized to be longer than original expected, revisions are effected in the amortization schedule. The historical cost of human resource is very similar to the book value of the physical assets. When an employee is recruited by a firm, he is employed with the obvious expectation that the return from him will far exceed the obvious involved in selecting, developing, and training in the same manner as the value of the fixed assets is increased by making additions to them. Such additional costs incurred in training and developing is also capitalized and are amortized over remaining life. This method is simple to understand and easy to work out. It meets the traditional accounting concepts of matching cost with revenue. It can provide a basis of evaluating the company's return on its investment in human resource. But it suffers from following limitations also. That is, it takes into account a part of the employee's acquisition cost and thus ignores the aggregate value of their potential services. Second, it is difficult to estimate the number of years over which the capitalized expenditure is to be amortized. Third, it is difficult to determine the rate of amortization, such as it should be increasing, constant, or decreasing one. Fourth and last, the economic value of human resource increases over the time as the people gain experiences. But in this approach, the cost decreases through amortization. Replacement cost approach. This approach was first suggested by Rensis Likert and was developed by Eric G. Flamhot on the basis of concept of replacement cost. Human resource of an organization are to be valued on the assumption that a new similar organization has to be created from scratch, and what would be the cost to the firm if the existing resources were required to be replaced with other persons of the equivalent talent and experiences. It takes into consideration all costs involved in recruiting, hiring, training, and developing the replacements to the present level of proficiency and familiarity with the organization. Opportunity cost approach. This method was first advocated by H.C. Kimin and Jones for a company with several divisional head bidding for the service of various people they need among themselves, and they include the bid price in the investment cost. Opportunity cost is the value of an asset when there is an alternative use of it. There is no opportunity cost for those employees that are not scarce, and also those at the top will be not available for auction. As such, only scarce people should comprise the value of human resources. This method can work for some of the people at shop floor and middle order management. Moreover, the author of this approach believes that a bidding process such as this is a promising approach toward more optimal allocation of personnel. Second approach is standard cost approach. This approach was advocated by David Watson. As per this approach, human resource data is used for setting standard cost for various HR functions like hiring and training. In fact, standard costing is usually determined every year. In this method, employees of an organization are first classified into different groups or grades based on their hierarchical position. Then, the standard cost is fixed for each grade of employees and their value ascertained. The aggregate standard cost computed for the entire workforce is regarded as the human resource value of the whole organization. This approach is obviously simple to understand and easy to operate, but the major limitation of this method is that it lacks objectivity in estimating the standard costing for human resources. Besides, determining the standard cost for every grade is a complex and time-consuming process. Value-based approach. According to the value-based approach, the value of human resource depends primarily on its ability to generate revenues. The major difference between the cost-based and value-based is that the former focuses mainly on total costs incurred by the organization in hiring and training employees, while the latter does not make much reference to the historic cost but emphasizes more on the future earning capacity of the human asset. Since the important human resource valuation model used for measuring the value of human resources are present value of the future earning model, certainty equivalent model, stochastic reward valuation model, unpurchased goodwill model, causal intervening and end result model, 5-dimension model, aggregate payment model, and human asset multiplier model. The present value of future earning. Lev and Shevard in 1971 proposed an economic valuation of employees based on present value of future earning, adjusted for the profitability of employees' death or separation or retirement. This method helps in determining what an employee's future contribution is worth today. The certainty equivalent model. The proponent of this model is Peck and Ogan. The two major components of this method are the net benefit and the certainty factor, which provides the means for determining the net present value of human resource. According to this model, the net benefit is the difference between the total investment made by the organization in acquiring, training, developing, integrating, and maintaining the employees and the total benefit received out of the skills, abilities, and knowledge of those employees. The stochastic reward valuation model. This model was originally developed by Eric Flamholtz. According to this model, the process of fixing the value of an employee depends upon the variability of that person from 4 different perspectives and potentialities. These are productivity, promotability, transferability, and retainability. This model perceives that the value of an employee depends upon the value of each of these factors or position concerned with that person. According to Flemhot, this reward model can help the organization in deciding an employee's estimated tenure in the organization, the mutual exclusive position like productivity and transferring that an employee is likely to occupy, the value of each position of the organization, and the profitability or probability that the employer would occupy a position at some time in the future. The human asset multiplier model. This method was advocated by W. J. Cools and D. F. Robinson. According to this approach, the valuation of human resource is normally made in same way as other business assets are valued, on a going concern concept basis. The going concern concept assumes that organization would continue to function for an infinite period of time. In this regard, Gills and Robinson developed a human asset multiplier which is applied on the gross remuneration of employees. This average multiplier is obtained from the financial formula which is based on the market value of the organization. The unpurchased goodwill model. The proponent of this method is Roger H. Hermanson. According to this method, the organization must ascertain its actual earnings and average it for the past few years. It should then identify the normal rate of return of the industry to which the organization belongs. In the next step, the organization must make a comparison between its actual average earning and the normal earning of the industry. The causal intervening and end result model. This model was introduced by Rensis Likert and David G. Bowers. They advocate the need to develop a participative approach to human resource management. According to them, the development of the participative approach requires the introduction of a new organizational structure and style of human behavior. These are called as causal variables. The result of changes in the organizational structure and style of management behavior would be an increase in productivity and performance and a decrease in cost and scrap level. This is known as outcomes or end results. The 5-dimension model. This model was advocated by Meyer and Flars. According to this approach, the 5 dimensions of workforce determine the value of human resource critically and collectively. These 5 dimensions of the employees are knowledge, skills, health, availability, and attitudes. These dimensions are factorial, that is core factor in nature and not addictive. Aggregate payment model. This model was developed by S.K. Chakrabarty, who suggests that the capital base of an organization should include the value of human assets. According to this method, the value of human resource is a function of the average salary of the employees and their average employment tenure in the organization. The model suggests that the ideal mode of identifying the value of human resources is group valuation and not individual valuation. Steps of aggregate payment model. There are 3 main steps in the aggregate payment model. First is segregation of employees into groups. Second, ascertaining the average salary of employees of each group. And third is measuring the average tenure of the employee based on past experience. So students, let's now summarize what we have learned in this module. Human resource accounting is the offshoot of various research studies conducted in the areas of accounting and finance. Human resource is an asset whose value gets appreciated over the period of time provided, placed, applied, and developed in the right direction. Thank you.